Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Common sense is so rare, it should probably be traded on an exchange. We all want clarity in life, just not the kind that forces us to change anything. Deadlines are like gym memberships, very motivating until you actually have to show up. Inflation is when your money starts behaving like it has better things to do. Diversification is just admitting you don't know what's going on, but in a sophisticated way.
The United States isn't blowing up, it's just slowly handing more of its income to bondholders. Interest costs are marching towards 25% of revenue, which means fiscal policy is starting to look like a subscription model you forgot to cancel. Here's a catch. There's no magic default number. Markets don't panic at a level, they panic at a loss of confidence. And the higher the interest burden climbs, the less room the government has to fight the next crisis without spooking investors. In short, debt sustainability isn't a cliff, it's a tightening corridor. And right now the walls are moving in. This is not a metals chart, it's a power map. And right now China is quietly running the industrial world's supply chain from behind the scenes. Start with the obvious. China dominates the boring but essential metals: aluminum, zinc, tin, titanium. Not glamorous but absolutely critical for EVs, grids and infrastructure. Control these and you control scale. Then comes concentration risk. Brazil owns niobium like a monopoly, utility. South Africa sits on key alloy metals, and Australia feeds the raw hunger of Asia. Supply chains aren't diversified, they are clustered. This isn't an energy transition, it's an energy reordering. And China isn't just participating, it's lapping the field with 38 reactors under construction, more than the rest of the world combined. Look at the pattern: India, Russia, Turkey, Egypt. These aren't climate slogans, they're energy security strategies. Baseload power, zero intermittency, and geopolitical insurance. Meanwhile, much of the West debated timelines, others poured concrete. Here's a market angle. Nuclear isn't just about electricity, it's a uranium demand story with long tails. Reactors lock in fuel demand for decades. Supply: concentrated, slow-moving, and politically sensitive. That red circle isn't just a bad month, it's what happens when a much larger market sneezes at once. March's $12 trillion wipeout is the biggest in absolute terms, but not the most violent. Back in 2008, the percentage shock was worse. Today, the base is just enormous. Same panic, bigger denominator, louder headline. So what's changed? Scale and speed. Passive flows, global linkage, and leverage means drawdowns now travel faster and hit harder in dollar terms, even if the percentage pain feels similar. So don't confuse size with severity. Markets did not break records for fear, they broke records for mass. This isn't a leaderboard anymore, it's a runway. Bangalore with 48 unicorns isn't leading, it's operating in a different league than Gurgaon or Bombay. Gurgaon was at 20, Bombay is at 16. Why? Bangalore has become India's full stack innovation engine. Talent, capital, founders, and tech culture all compounding in one place. It's not just startups, it's startup infra. Meanwhile, Gurgaon leans into consumer tech and platforms, Bombay into fintech and capital markets, but neither has Bangalore's density advantage. Here's a macro angle. Once ecosystems reach critical mass, they don't grow linearly, they snowball. More exits, more capital, more founders, and more unicorns. This chart quietly exposes a brutal reality. Your returns depend less on the asset and more on the currency you measure it in. For an investor in India, the Nifty 50 in green looks like a compounding machine. But switch the lens into USD via iShares MSCI India ETF and suddenly the ride looks a lot flatter. Meanwhile, gold tells the opposite story. In dollar, in red, it's decent. In rupees, blue, it's a star. Because the currency did half the work. That's the punchline. Equity returns are local, purchasing power is global. If your base currency is weakening, even mediocre assets can look brilliant. If it's strong, even great assets can disappoint.